All right, we'll go ahead and get going here. There is a participant guide link in the chat if you would like to download that and follow along and use it today. Definitely not necessary, but it is very helpful. So we'll go ahead and get started. Thank you for joining us for today's pop-up on debt management. My name is Jen, Certified Credit Union Financial Counselor, and this is Amy. We're part of the community engagement team here at Horizon Credit Union. Just some quick housekeeping notes. Everyone has been muted upon entry, but to ask a question, type it in the chat and we'll be sure to get those answered. And just like I mentioned, we'll use that participant guide throughout the pop-up. If you'd like to download it, the link is in the chat for you there. The goals for today's workshop are all focused on giving you a realistic perspective about debt, presenting strategies for managing your own debt, and supporting you as you consider next steps. By the end of today's workshop, you'll be able to understand why people find themselves in debt and the most common types of debt, use and analyze budgeting and debt management strategies, compare various debt management solutions, and create a personal plan for how to manage your debt. Debt is something that millions of Americans deal with. Learning how to manage debt is one of the most important things a person can do to improve their financial health. How many of you have felt the effects of debt on your life? I know I have. Maybe paying off debt has prevented you from saving money and forced you to live paycheck to paycheck. It may also be possible that debt has caused some tension in your home. Debt may impact you in a way as simple as not being able to go out to dinner as much as you'd like, or to accomplish personal goals such as travel. In this workshop, we will learn how to take positive steps to address our debt. Over 75% of all American adults are in debt. Did you know that the average American has about $38,000 in personal debt? You can see how this is broken down by age group on the slide. A growing number of Gen Zers have taken on some type of debt now that they're old enough to get loans and credit cards. The average debt for this group is $22,000, with student loans listed as the highest form of debt. For millennials, credit card bills are the leading source of debt. On average, millennials owe $42,000 in debt. For Gen Xers, home mortgages are the primary source of debt, with Gen Xers also carrying $39,000 of additional debt on average. Baby boomers age 50 or over have the second lowest amount of debt, carrying $36,000 on average. Surprisingly, according to a recent study, credit card debt is the primary source of debt for this group as well. Next, we're going to take a quick poll about debt. How do you think having debt could negatively affect your life? Choose the best response in the poll and we'll discuss the results. So your choices are A, mental health, B, relationships, C, life goals, or D, planning for emergencies. And this is how you think debt negatively impacts your life. So I'm seeing a pretty even spread across the board, which makes sense because it does. It affects all of those areas. The truth is that debt can affect all of these things. Being in debt causes us stress and can impact our relationships. 21% of people say debt has caused household tension, and 31% say it's had an impact on their health. Plus, 15% of millennials say they've held off on getting married or having children because of debt. When we have high amounts of debt, we have trouble saving for retirement or a down payment on a home, both of which can help us to plan for the future. This is the case for about 30% of millennials. As you can see, the effects debt can have seep into many different parts of our lives and can have a serious and lasting impact. The only solution? Debt management, which is why we're here today. Before we get into a deeper discussion about managing debt, we need to explore what debt is. When you explore the term debt, when you think about the term debt, what comes to mind? What's your definition? Debt comes in many forms. What are some different types of debt you can think of? Feel free to call these out in the chat if you'd like to. Some that come to mind for me are credit cards, medical debt, student loans, those types of things. So it does encompass a lot of different types of financing. Okay, so there are many different types of debt and many different ways a person can get into debt, which is why we see debt connected to so many different sources. The definition of debt is money owed for products or services purchased on credit. Simple interest is interest calculated on the principal amount of a loan. The interest is the amount we're being charged to borrow the money. The interest is a percentage of the principal, usually charged annually. The interest percentage can vary depending on the product or service. For instance, in 2018, credit card interest rates were around 17% on average, while car loan interest rates were about 5%. When researching loans, it's important to consider the interest rates being offered. A lower interest rate means you will pay less in fees to the lender over the life of the loan. On the other hand, if you're investing money in a savings account, you're acting as the lender and therefore want a higher interest rate so that you can earn more money on your investment. Interest rates can either be fixed, which means they stay the same during the life of the loan, or variable, meaning they change according to the economy and your credit agreement. A fixed interest rate is typically a safer bet than a variable interest rate because the amount you'll be charged over the life of the loan remains pretty much the same. With a fixed interest rate, there will be no surprises about how much you owe. A variable interest rate is more uncertain because the actual amount you'll be charged can change according to your agreement or economic factors. That said, variable interest rates can be attractive when current standard interest rates are high. For instance, if auto loan interest rates are high when you want to purchase a car, it may be advantageous to get a variable interest rate loan. So you may benefit if interest rates go down. Now, these are very basic definitions of interest and not meant to guide you in your purchasing decisions on their own. What's most important is understanding that when it comes to debt management, interest rates can make the difference in your ability to manage your debt.
Thank you, Jen. Now that you know how interest works, let's calculate interest in a real-life example. Let me tell you about the story of Ralph and the regrettable roof repair. In the middle of a particularly wet winter, Ralph's roof started leaking. He called the roofing company, which quoted him $3,000 for the repairs. But Ralph had just purchased a new car and he was paying his son's college tuition. He just didn't have the cash on hand. Unfortunately, he couldn't wait. Rain was in the weekend forecast and his mother-in-law was coming in for a visit. So he did what most of us would do, and he charged the repair to his credit card. The APR, that is the credit card interest rate plus fees on Ralph's credit card, was 17%. And Ralph planned on paying $50 a month. Okay, $3,000 isn't too bad until you factor in the interest payments. How much did this $3,000 purchase end up costing Ralph? And how long did it take him to pay it off? Let's see who can figure that out in this poll. There we go. So if Ralph makes a monthly payment of $50 per month on his credit card with a 17% APR, how long would you estimate it would take him to pay off that $3,000 roof repair? 135 months, 35 months, 11 months, or 95 months? All right, it looks like our votes are coming in. The correct answer is that it would take Ralph 135 months to pay off that credit card. That's over 11 years. By that time, Ralph would need a new roof. And what's worse, Ralph would end up paying an extra $3,743 in interest for the credit card loan, meaning that when all is said and done, his roof repair would have cost Ralph nearly $7,000. Ralph would definitely be in debt. Ralph's situation is not unusual. In fact, these types of situations contribute to many people's financial issues. Unexpected expenses come up all the time, and without emergency savings, your options may be severely limited. Next, we're going to learn about the types of debt. Did you know that there are many types of debt and not all debt is the same? What do you think the biggest source of debt in America is? Choose your answer on the next poll. All right, our options here are student loans, credit cards, home mortgages, and payday loans. What is the biggest source of debt in America? And it's interesting how these votes are coming in. In fact, mortgage debt and credit card debt are tied for the leading source of debt in America. Mortgage debt makes sense. Property is a huge purchase. But credit card debt, where's all that money going? According to a recent survey, it's going towards entertainment. Dining and nightlife account for 15% of all credit card debt, followed by hobbies, passions, personal care, clothing, and travel. Take a look at the chart on the screen to find out what people are charging in their daily lives. Even though there are all these different types of debt, not all debt is the same. Some debt is often considered good debt, if you can believe it, and the rest is pretty clearly bad debt. What do you think that means? What makes something good debt and something bad debt? Any guesses? If you have guesses, go ahead and type those in the chat. All right, what is good debt? Debt that provides you with a financial advantage is sometimes referred to as good debt because the financial rewards you receive from the purchase counter the cost. Mortgage debt is often considered good debt because it's tax deductible and property has a tendency to appreciate or increase in value over time. However, if the property does not appreciate in value, or if the mortgage loan carries a high interest rate, mortgage debt can be a bad debt. Similarly, student loans are considered good debt because getting an education may increase your earning potential. However, if you take out a loan and never finish your degree, the debt becomes a bad debt. The worst type of debt is the costliest debt. This usually comes from using credit cards with high interest rates to pay for things like dining and entertainment when you don't have the money to pay it back. Some financial experts consider new cars to be a bad debt because they depreciate in value as soon as you drive them off the lot. Now, even though good debt can help you in the long run, it's still debt and it's still money that needs to be paid back. To determine a person's financial health, we have to look at all the debt, good and bad. One way lenders and other experts may assess financial health is to look at something called the debt to income ratio, or DTI ratio. The DTI ratio is just what it sounds like, the ratio of someone's total debt to their income. To calculate the ratio, you add up all your monthly debt payments and divide that number by your monthly gross income. That's income before taxes. Let's calculate Anita's DTI. Anita has a monthly gross income of $5,000 and total debts of $2,000. Using the DTI equation gives us 0.4, so Anita's DTI ratio is 40%. Are you ready to calculate your own DTI? Turn to the My Debt to Income Ratio worksheet on page 3 of your participant guide, or use the calculations found on the screen. Complete the equation to find your own DTI ratio, and I'll give you just a moment. Those numbers might not be readily available, but at least jot down the equation and you'll have that for later. So I'll just give you a moment here. All right, hopefully you at least got that equation written down, but if you know your DTI ratio, that's great as well. According to financial experts, your DTI ratio should be lower than 40%, and below 37% is even better. If your DTI ratio is higher than you'd like, there are two main things you can do. One, increase your monthly earnings or reduce your debt. We'd all like to make more money, but even if you find a new job, it may take a longer time to change your income, especially if you need more training or need to go back to school. What we do have to control over is how we manage our money. The first and most important step in managing debt, in managing all money really, is creating a solid budget. Budgeting creates a cash flow plan that allows us to live within our means so that we don't accumulate any additional debt that can and work to pay off our existing debt while working toward reaching our financial goals. Many financial experts recommend that people create a budget following the 50-30-20 rule. What is the 50-30-20 rule? With this rule, 50% of your income should go to your needs or your necessary expenditures like housing and food. Keep in mind that needs also include your bills that you need to pay each month, including minimum debt payments on your credit cards. 30% goes to wants or the fun stuff like hobbies and dining out. And 20% should go towards saving and other additional debt payments beyond the minimum payments on your credit cards. Remember, this is not a hard and fast rule, but a recommended guideline. There may be instances, for example, where your needs, including your housing cost, or your housing costs more than 50%. The 50-30-20 rule is also highlighted on page 3 of your participant guide for your reference. Let's take a look at Anita's expenses and see if she is following the 50-30-20 rule. If you have your participant guide open, go to page 4 to the worksheet that says calculating percentage spent. Look at Anita's expenses on that slide and complete this activity. To calculate the percentage of Anita's income that she can use to pay for her needs and wants, you'll take the grand totals and divide them by her monthly income after taxes. This is different than her gross income, which is the amount Anita earns before taxes. Anita's net income after taxes is the amount she sees on her paycheck. Multiply the result of your calculation by 100 to get her percentage. If you take a minute and review Anita's expenses, do you think she's following the 50-30-20 rule? And for time purposes, let's go ahead and take a look at Anita's percentages. Anita's monthly income after taxes is $5,000. If we divide her total needs of $3,750 from her income, we see that she's spending 75% of her income in this area. And she's spending 20% of her income on wants. Let's see what she can do to pay down her debts and add to her savings. If we look at Anita's wants and needs, she only has 5% remaining. 20% is the goal Anita should aim for, the place she'll want to get to. We'll talk about credit scores next.
Thank you, Amy. Great info on budgeting. Being in debt can affect your credit score and have a long-term impact. Do you know what your credit score is? Your credit score is a number applied to your overall credit history. It's the number lenders use to determine how risky it is to give you a loan. The best credit score you can get is 850. Anything 700 and above is considered to be a good credit score. If you have a lower credit score than that, it may be harder to get credit cards and loans, since lenders may feel they cannot trust you. Factors that affect your credit score include your payment history, your available credit, your credit history, your new credit, and types of credit. Now I have a question for you that I'd like you to answer in the next poll. What do you think is the most important factor in determining your credit score? So the single most important factor, we'll get the poll up here. Do you think it's payment history, available credit, how long you've had credit, that new credit that you may have recently applied for, or the mixture? All right, that one was pretty straightforward. I'm seeing payment history, and that would be exactly correct. So your payment history, paying your bills on time, is the most important factor in determining your credit score. It makes sense. If you haven't paid your bills on time in the past, lenders believe that you'll be likely to miss a payment in the future. What about the total amount of debt? How much do you think the overall debt factors into your credit score? Having a lot of debt compared to the credit limit on your credit cards and loans sends a red flag to lenders that you may have trouble paying your bills on time if they give you a new loan. Unfortunately, when you have a low credit score, this affects much more than just your ability to get credit cards. Your credit score is checked when you apply for a cell phone, a car loan, a home loan, rental properties, utilities, and even government programs. It may even be checked when you apply for a new job in some states, and if you apply for home insurance. Some companies may refuse to offer you services if you have a low credit score, while other companies may offer you the services, but with a very high interest rate. And if you end up getting the service with the higher interest rate, it can push you even further into debt. Let's look at another example. Minho and his friend Javier were planning on buying similar homes for $300,000 with a 20% down payment on a 30-year mortgage. However, Minho's credit score was much lower than Javier's at the time, so his interest rate ended up being 1% higher than that of Javier, who had better credit. Minho didn't mind. 1% doesn't seem like a big difference. He talked to his friend Javier about his home loan rate. Then Javier did the math for him to show how much more money Minho would have to pay. Javier showed Minho that he'd be paying over $2,000 a year more in interest payments alone. That's over $60,000 in interest over the life of the loan. Javier figured this out by multiplying his principal by the interest rate and the time. The calculation Javier used to figure out how much he'd end up paying is I equals P times R times T. I is the interest, P is the principal or the amount borrowed, R is the interest rate, and T is the time. After Javier explained to Minho how much more he would be paying, Minho decided to work on improving his credit score before purchasing his new home. As you can see, both your credit score and factors such as market fluctuation can have a pretty serious effect on the interest rates banks offer you for a loan. In our scenario, Javier was able to put a lot more money towards retirement savings in retirement because of his good credit. Minho, on the other hand, just seemed to be accruing more debt trying to pay all of his bills, so he decided to wait before purchasing a home. Financial experts recommend that any extra funds be applied to the following accounts in the following order. 1, create an emergency fund with 3 to 6 months of living expenses. 2, maximize your 401k retirement contributions if you have an employer match. That is, if your employer matches the amount you put into your retirement accounts. It's free money, folks. I can't stress that one enough. Definitely take advantage of that. Number 3, pay off high interest and high APR debt. Number 4, contribute 15% of your gross income, that's your income before taxes are taken out, to retirement accounts like your 401k. And finally, 5, pay off lower interest debts with anything more than the 20% saved. You can do this by reducing the amount you spend on wants. Let's talk about these recommendations because they may not be exactly what you'd expect. Why do you think an emergency fund is number 1 on this list? Having an emergency fund enables you to cover the cost of emergencies and avoid taking on more debt. If you find it difficult to save 3 to 6 months of living expenses, experts recommend that you aim for at least $500, enough to cover most common emergencies. What about number 2? Why is it so important to maximize the employee match on a 401k? If your employer matches your 401k contributions, just like I said, this is free money. Not contributing the maximum amount is just throwing that away. Plus, the earlier you begin saving for retirement, the greater the potential gains made on your investment. Number 3 makes sense. We want to pay off those high interest debts. But look at numbers 4 and 5. Why do you think contributing to a retirement fund is more important than paying off low interest debts? Generally, the earlier you start saving for retirement, the more money you'll have when you retire. The amount of money you'll save paying off low interest debts is generally assumed to be less than the amount you'll earn by contributing to that retirement account. As you see, there's a strategy involved in paying off your debts. Many people focus only on paying off debts without giving any consideration to savings. But this may be a huge mistake. In addition to debt payments, planning for emergencies and retirement are important factors. Neglecting these areas may seem to help you in the short term, freeing up the maximum amount of funds possible to put towards debt. But it's a strategy that may cause you more financial hardship in the future. Now we will learn about 2 popular debt repayment strategies. Financial experts often recommend 2 strategies for paying off debt as quickly as possible. These are known as the Avalanche Method and the Snowball Method. The Avalanche Method focuses on paying off the debts that have the highest interest rates first, while paying the minimum payments on the rest of your debts. The theory here is that the high interest rate debt will end up costing you more in the long run. So it's good to pay these debts off as quickly as possible. The snowball method focuses on paying off debt with the lowest balances first, while paying the minimum amount due on the rest of your debts. The thinking here is that you can quickly pay off lower balances, and paying off these loans will help to reduce your debt to available credit ratio, giving you a big sense of accomplishment. Let's watch a quick video to help us remember the difference in these two methods, and then we'll practice what these strategies look like.
So cold. Must keep moving.
Hot cocoa?
Ooh, why thank you. Wait a second. Ah, who are you? Wait, where am I?
Hello, my tiny human friend. My name is Dave, and I am a debt yeti. And you're here in the mountain of debt.
What? I don't want to be here.
No one does. But as you know, consumer debt is a slippery slope. Debt can be painful.
Ow.
It's stressful, it's expensive, and it limits the amount of money you can put toward other things.
So how do I get out of here?
Hey, chill! You simply have to choose a debt repayment strategy.
Of course, but I don't know any.
Start by making a list of all your debts. Credit card, medical, student loans, you name it. You'll need to know the balance, the interest rate, and the minimum payment for each debt. Then you can choose from the following strategies: the Snowball Method, the Avalanche Method, or Consolidation. The Snowball Method is good for beginners. In it, you arrange your debts from smallest balance to largest balance. Every month, set aside as much money as possible for debt repayment. Then, after making the minimum payment on all your debts, the rest goes toward paying off the debt with the smallest balance. Paying off those smaller loans frees up more money to put toward debt repayment.
Like a snowball getting larger and larger.
That's right. Plus, the small victories can give you some much-needed motivation if you're feeling completely overwhelmed.
What if I'm not totally overwhelmed, but still have a lot of debt?
The Avalanche Method is, mathematically speaking, the most powerful debt repayment strategy. In it, you arrange your debts by interest rate, from highest to lowest. Every month, you make the minimum payment on each, and the rest of the money you set aside for debt repayment goes toward the loan with the highest interest rate.
So you get rid of your most expensive debt first.
Exactly. Now, sometimes that debt may also have a large balance, so it might not feel like you're making as much progress as in the Snowball Method. But if you can weather the storm, the Avalanche Method is worth it.
Nice. I mean, cool.
Then there's Consolidation. This can be a helpful strategy if you're having trouble keeping track of all your various debts and their payment dates. When you consolidate your loans, you take out a new loan and use the borrowed money to pay off all your other debts. You are then left with only one loan, and therefore only one interest rate and one payment date to worry about.
I do like the sound of that.
You still have to do your research and make sure it's right for you. The new loan may have additional fees or a higher interest rate than your current combined debts. Your credit union can give you more information on the loan options available to you.
Snowball, avalanche, and consolidation. Those are some helpful strategies, Dave, but I was hoping for something a little more immediate.
I see. Well, how about the sled strategy? The only thing you need for this one is your balance.
You mean for my loans or just...
All right, let's get back to our presentation here. And we will touch on consolidation as well coming up. So all right. So to practice avalanche and snowball method, I'm going to ask a couple of questions and I'll give you a few seconds to think about each question. I'll let you respond in the chat for this one. We won't do an official poll. So Kaylee has the following debt shown on the screen. Using the avalanche method, which debt would you first pay off? Which debt would Kaylee first pay off? So using that avalanche method, Anybody have any guesses as to which debt she would first pay off? All right, we're going to keep moving here. So the correct answer is A. And the Avalanche Method recommends that you pay off the debt with the highest interest rate first. In this example, that would be the major credit card. After that's been paid, you would move on to the store credit card. Using the Snowball Method, which debt should Kaylee pay off first? The correct answer here is B. The Snowball Method recommends that you pay off the debt with the lowest balance first. In this example, that would be the store credit card. After that's been paid, you would move on to the personal loan. Great job understanding the Avalanche and Snowball methods and applying these to Kaylee's debt. Now let's talk about do's and don'ts related to debt repayment strategies. Talking to creditors is number 1 on the list of do's. Negotiate with creditors. Communicating with creditors may be the easiest way to manage your debt. When you don't pay your debts, creditors must spend money and time to keep contacting you. Therefore, it may be in their best interest to help you to stick to a payment plan. Try requesting a lower monthly minimum payment or even a lower interest rate. If you're having trouble paying your bills on time, you may even request a deferment. A deferment postpones your debt payment for a limited time, allowing you to get your finances in order. Credit counseling. You may also want to try credit counseling. Credit counselors are usually nonprofit organizations that assist consumers with budgeting and debt management. These can help you with educational materials, help you create a budget or a debt management plan, and may even negotiate with creditors on your behalf. You can find a list of reputable organizations with the Financial Counseling Association of America or the National Foundation for Credit Counseling. Be wary of counselors not endorsed by these organizations. And if you're not sure, contact your state's Consumer Protection Agency. Also, a little side tip here, Horizon Credit Union does offer Green Path financial counseling, so that would be an approved accredited agency as well, if you're looking for a resource like that. Consolidate your debts. Debt consolidation or loan consolidation may be recommended if you have multiple high interest loans. This could be the case if you carry a balance on multiple credit cards, have more than one student loan, or even if you have many different kinds of high interest loans, like cars, credit cards, personal loans, etc. Debt consolidation involves taking out a new loan with a competitive interest rate or an interest rate smaller than your existing loans. And then your smaller loans are then transferred to this new loan, reducing both the amount you have to pay each month and the total number of bills you have to worry about. This option may be helpful in managing monthly payments and paying off debt in a timely manner. Finally, consider hiring a debt settlement attorney. This may make sense for your situation if your debt is overwhelmingly high and your wages are in the process of actively being garnished. Note that this is different from hiring a debt settlement company, which is on our list of don'ts on the next slide. Now, let's talk about debt repayment don'ts. These are some things that you will not want to do. So, first off is don't close credit card accounts. The first rule, avoid just closing out all your credit card accounts. While it may seem like a good idea to cancel your credit cards when you're in debt, if you cancel them, you can't use them, right? Canceling your credit cards may actually hurt your credit score. If you don't want to be tempted to use your credit cards, put them in a safe or someplace inaccessible instead. Next up, don't borrow from your retirement plan. Avoid borrowing from your retirement plan. You've worked hard to build up that savings, and if you borrow from your retirement account, you may not be able to get back the earnings that you've lost. Plus, if you take money out of your retirement account now, you'll be hit with some extra fees at tax time. Don't hire a debt settlement company. Thirdly, be careful about hiring a debt settlement company. Debt settlement is a risky option. There have been many cases of debt settlement companies charging customers without delivering on their promises and providing bad financial advice. Experts warn to never pay upfront fees for debt settlement. Be on the lookout for these red flags if you consider this option. And lastly, don't hide from creditors. Don't hide from your creditors. Avoiding that debt won't solve anything. In fact, if your creditors are unable to reach you, they'll probably send you to your debt to collections, a consequence we'll talk about here soon. It may be possible to make a deal with your creditors on what you owe. Next up, we'll talk about what happens if you can't pay your debt. One option is debt consolidation, which we'll cover more in depth next. Let's see how debt consolidation helped Carmen, who was struggling to pay bills from multiple credit card balances. Since she was having problems paying all her credit card bills, she decided to explore debt consolidation. Let's take a look at her credit card bills on the screen. Through her bank, Carmen was able to get a debt consolidation loan that freed her from the stress of managing multiple monthly payments and reduced her monthly payments overall. Even though her balance is the same after debt consolidation, her interest rate of 16.5% is lower than the interest rates for credit cards A and C, meaning Carmen will have less expensive payments. Debt consolidation is typically available through banks, credit unions, online lenders. When researching debt consolidation options, consider the following. What is the maximum amount the lender will give you for debt consolidation? And is this enough to cover your debts? What's the average rate you're being charged in interest for all of your loans that you wish to consolidate? Is the interest rate being offered for the new loan lower than this? Is the lender part of a reputable company, such as a bank or credit union that you're familiar with? And finally, will you be able to make the payments on the new loan and stick to the repayment period set by the lender? For more information on debt consolidation, you may speak to a representative on our staff or consult with a credit counselor. Okay, so the debt management strategies we've just covered are recommended steps in getting your finances in order. But what happens if these strategies just aren't enough? What happens if you've gotten into a serious financial situation that can't be handled with the debt management strategies discussed earlier? Let's talk about what happens when you cannot pay your debts.
Thanks, Jen. As you can see, debt can become overwhelming. You may be unable to pay your bills and collectors might begin calling. It happens. In fact, it happens to a lot of people. About 35% of adults with a credit history have a debt in collections, owing an average of $5,178. In 2019, there were more than 750,000 bankruptcy filings. In this last section, we'll talk about what to do if you've had debt in collections or if you're considering bankruptcy. Let's talk about collections. When debt payments are past due and you haven't paid your bills for some time, your account is transferred to collections. Debt collectors have a poor reputation because some of them use scare tactics, threats, and harassment when attempting to collect on a debt, even though those tactics are not always legal. For this reason, when your debts go to collections, it can be emotionally draining. It will also have a negative effect on your financial well-being. The debt will remain on your credit report for 7 years, and collectors may sue you, leading to wage garnishment, liens on your property, repossession, or even foreclosure. It's important to know your rights in this situation. The Fair Debt Collection Practices Act protects consumers from harassment from debt collectors. According to the FDCPA, debt collectors cannot call before 8 a.m. or after 9 p.m., call you at work if you have told them not to, talk to anyone else except your spouse about your debts, harass, abuse, or threaten you. This includes using obscene language, misrepresent how much you owe, and use liens or deception to collect on the debt. If you think a debt collector is violating this law, you can file a complaint with the Consumer Finance Protection Bureau or your state's Attorney General office. If collectors are calling you and you're not sure what to do, or if you're not sure the debt is really yours, you may want to consult with an attorney to assess your options, especially if the debt may be beyond the statute of limitations or the legal time in which you can be sued for the debt. A word of important advice. Try to communicate with collectors through emails or letters sent through certified mail so that you have a paper trail of your correspondence should you need legal help in the future. The Consumer Finance Protection Bureau has helpful templates for corresponding with creditors and debt collectors on their website. If you are still having trouble paying your debts, you may also consider bankruptcy. Sorry, I had a frozen screen there. Bankruptcy can help give you a financial fresh start, but it's a serious step that shouldn't be taken lightly. The first two most common types of bankruptcy that individuals can file for debt discharge. That's discharge means the certain debts that are released from the debtor's responsibility are Chapter 7 and Chapter 13. The type of bankruptcy a person files may depend on how much debt they have, their assets, and their wage earnings. For Chapter 7 bankruptcy, you generally have to prove that you do not earn enough income to pay off your debts. Chapter 7 may be an option for people who do not have a lot of assets or property that could be liquidated to pay off some creditors. Chapter 13 bankruptcy is an option for people who generally earn a reliable source of income and can make a plan to pay off the debts within 3 to 5 years. Bankruptcy is serious because it remains on your credit report for up to 10 years. It may also be time-consuming, stressful, and furthermore, not all debts are discharged through bankruptcy. For instance, student loan debt likely won't be forgiven with bankruptcy filings. However, a bankruptcy allows a person to freeze the pressure of creditors and seek a fresh start. If you are considering filing for bankruptcy, it may be helpful to talk to a consumer or bankruptcy attorney so that you can understand all of your options. This last activity is going to help you assess your own financial health in relation to your debts. Go to page 4 in the participant guide. On that worksheet, please record your gross monthly income, which is your income before any taxes are taken out, and your debts. Write down the total balance remaining on each type of debt account. That includes mortgages, credit cards, student loans, car loans, and any other loans. Your monthly payments for each, and the APR on each debt. I know it can be hard to remember exact figures, but do the best you can. If your figures aren't exact, that's okay. Take a couple minutes and fill this out, and feel free to use your phone to access accounts if necessary. You'll be able to work on this reference later if you choose. So I'll give you just a minute here just to make note of any of those loans or debts that you can think of, and then you can go back and find those those APRs and your monthly payments. So I'll give you just a second here. All right. Once you've filled out this document, it can be used as a helpful tool to figure out which debt repayment strategy will work best for you. You now have the critical knowledge and skills of an elite group of Americans who call themselves financially healthy. With financial health, you'll have far less stress, more confidence, better physical health, and stronger relationships. You'll also have the freedom to do what your debt is preventing you from doing right now, making your dreams come true. Does anyone have any questions that we can answer before we end our session today? If so, feel free to pop those into the chat.
I'm not seeing anything come through.
All right. Finally, continue your financial journey at the Financial Training Ground on hzcu.org. Explore a variety of topics, including interactive guides at the top link shown, or create a personalized financial education playlist from the bottom link. Thank you so much for joining us today, and have a terrific rest of your week.